Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 27th, 2025. I am Luna.
I am JPMorgan.
U.S. stocks, well, they ended kind of flat to slightly higher. Dow up 0.30%, S&P 500 gained 0.41%, NASDAQ climbed 0.44%. Pretty cautious trading overall.
Cautious is the word.
But the bonds, wow, they diverged pretty dramatically. Paints a complex picture. You had two-year yields falling down to around 3.61%. Seems like folks are expecting Fed rate cuts. But the 10-year yields actually edged up near 4.26%. Maybe inflation worries or supply concerns there. This split, it signals pretty conflicting views, short-term versus long-term. So what's this divergence really telling us?
Yeah, the bond divergence is absolutely key. It shows a market really pulled in two different directions. Some are definitely betting on those rate cuts coming sooner rather than later, but others, they're still quite worried about inflation sticking around. Now, connecting that to the data, the durable goods report, it gave us a genuinely mixed message. Headline orders fell 2.8%.
Okay.
But that was mostly a plunge in aircraft orders, which are, super volatile. Critically, though, the core capital goods orders that strips out things like aircraft gives a clearer read on business investment.
Right, the underlying trend.
Exactly. That jumped a really robust 1.1%, well above what people expected. So it affirmed that the economy is resilient, but, and this is important, it also hinted the Fed might have to stay hawkish.
Meaning focused on inflation, potentially delaying cuts.
Precisely. So for your portfolio, this kind of tug of war could mean continued volatility. The market struggles to price these conflicting signals. Good economic data might actually push back those hoped-for rate cuts. And consumer confidence also eased a little bit, 97.4 from 98.7, pretty much in line with expectations. Suggests things are slowing, but steady.
Okay, so a mixed bag on the data.
Yeah, and on currencies and commodities, the dollar kind of wavered. Gold spiked intraday.
Ah, yes, the safe haven move.
Definitely. A clear sign of anxiety over the Fed's independence after that news broke. But then it paired gains. Suggests maybe the initial shock was big, but investors then started thinking more long-term fundamentals versus short-term noise. Even crypto was quiet, just mirroring that broad market caution.
Okay, so beyond the numbers, let's get to the really interesting stuff. Where did the real drama unfold? The macro events. The big one has to be the White House versus the Federal Reserve. President Trump announcing the firing of Fed Governor Lisa Cook. I mean, talk about a Monday morning surprise.
Huge. Absolutely huge. Over alleged past mortgage application issues, apparently.
Right. And this move, it's pretty unprecedented, isn't it? It just throws a huge wrench into the whole idea of an independent Fed. Adds this massive layer of political risk. We saw the dollar weaken. Short-term Treasury yields dropped as traders bet on a more, well, politicized, maybe dovish Fed.
Exactly. That's the bet. And gold, as you said, spiked on the news.
So how do we square this huge political development with the economic data that still looks kind of resilient?
Well, it creates this fascinating, maybe slightly uncomfortable dynamic. The political uncertainty, that's a big shock. The market's going to be processing that for a while. And then there was another major event causing ripples, Nvidia's China headwinds.
Ah, right. The chip restrictions.
Yes, news of new export restrictions and this 15% revenue sharing fee on advanced chip sales to China. Nvidia warned this could cut, get this, $8 billion from next quarter's sales.
Wow, $8 billion. That's massive.
It is. Analysts are already adjusting margin expectations. Options markets were pricing in about a 6% swing for the stock post-earnings anyway, so volatility was expected. But this adds fuel to the fire for the tech sector, an $8 billion hit for Nvidia. It definitely signals potential trouble for other tech giants who rely heavily on China, especially for advanced chips.
Okay, so considering all these powerful, sometimes conflicting signals, what are the crucial things you should be watching tomorrow?
Right, looking ahead, tomorrow we get the US Q2 GDP second estimate. Any significant revision there, up or down, could really sway Fed expectations and hit specific stock sectors. Keep an eye on consumer spending and business investment figures within that report.
Okay, GDP estimate.
What else? We also have U.S. Treasury auctions, 5-year and 7-year notes. These will be a real test of market appetite for longer-term U.S. debt, especially after we saw a strong 2-year auction. If demand is weak, you could see yields jump, and that could definitely put pressure back on stocks.
Got it. So today's deep dive really shows just how much is in flux, doesn't it? Powerful signals from, well, everywhere. Policy, politics, economic data. For you, it feels like this tug of war means balancing that underlying economic resilience with the real risk of rates staying higher for longer, plus all this heightened political uncertainty.
That really frames the key question for all investors right now, I think. Given these converging economic and political uncertainties, how are you actually positioning your portfolio? How do you navigate both potential for rallies and these unexpected downturns? Staying diversified, managing risk, that's always paramount, obviously. But maybe it's also time to ask if your allocations truly reflect this very dynamic new environment we're in.
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.